Right, thank you very much. So 10 minutes to explain the future of money. Let's take this challenge. Well, first of all, the best teacher to ask about what the future of money might look like is history. And history teaches us two major lessons. The one is people started to use money as a generally accepted means of exchange to facilitate the division of labor and not in order to create a macro management tool that we can use for stabilization policy issues or the like. Number one. Number two is money once emerged as a product of the free market. So there is nothing to assume that it might not become such a product of the free market. And also we should be cautious not to take the current monetary system, which is characterized by being debt-backed, a fractional reserve system with state-owned central banks. We should be cautious not to take this system as being natural or normal or permanent or whatsoever, because it is only 48 years old, so a rather short episode in the long period, the long history of money. And the reserve medium within this public-private partnership is cash only, actually. And what we are seeing over a couple of years already is that the cash use in the real economy is shrinking. And of course, digitalization now kicks in and might lead to a situation where people will not use any cash anymore. And this, in our view, asks two major questions. The first is, or comes with two major aspects. The first is strengthened currency competition. So could it be that digitalization leads to a re-emergence of private issuers of money? The second is, what would happen if the central bank itself became an issuer of digital money and abolish its cash altogether? Well, starting with the let's say, larger scope for currency competition, of course, the ideas of Hayek come to mind. And at his time, in the 1970s, everyone thought, well, currency competition is quite unpractical. Would you want to have different currencies in your wallet? This looked more like an utopia than anything that might be realized in the real world. But, of course, today, when cash disappears, this problem becomes quite different. And it's also important to note that currency competition in the digital age would probably not be fostered by the banking system, but rather by the outsiders from the banking system, rather by huge digital network companies who are more interested in the data that they can gather by providing a means of exchange, rather than to become a bank themselves. And this is important also for monetary policy, because the key idea that Hayek had in mind was not to have as many currencies as possible in the pockets of their economic agents, but to put the central banks under competitive pressure. So even if these issuers, the private issuers of money, do never see the light of the day, they might still limit their scope for monetary policy, because whenever central banks would go too far with their money-making machine, these potential competitors would become effective competitive. And the interesting thing also, when we talk about the monetary system, is that quite different to the decision whether we should switch from a left-hand traffic system to a right-hand traffic system, there you need a collective concerted action when it comes to using currencies, you can use them parallelly. So you could experiment around with new monies and just test whether they suit your needs better than what is provided by their current system. So this is very important that we can really have currency competition, and this is a global competition. This will not be limited to individual countries, but those issuers of private digital money would clearly address the global market, not national markets. Which brings me to the central bank digital currencies. So what would happen if if the central banks themselves stopped the issuance of cash? Well, then they would give up the legal tender. This is what they probably will not do. So they will substitute it by something else. And this something else would then be digital money. And the important difference to cash is that this would be central bank money, or rather I should say the difference to the current monetary base is that this is digital money that would be available for all participants in the real economy. So this is kind of a fat coin account for everyone. As we sit here, none of us has an ECB account, but then this would become a possibility. And this has far-reaching implications on the monetary system, which I'd like to illustrate by the following graphs. What you see here is the current economic system. So you have cash as a fraction of the overall circulating quantity of money, and the lion's share of the money that is used in the real economy are sight deposits issued by commercial banks, and they are just redeemable for central bank money upon request. And from the perspective of a participant of the real economy, this means they are redeemable in cash. Now let's switch and substitute cash for CBDC, and then these sight deposits would be redeemable for central bank money again, of course, but this time it would just be the same as what the real sector currently holds as the substitute for cash. So there's very little reason to assume why this fractional reserve system should survive this swap in the issuance of CDBC. And there are two possibilities. Either commercial banks will get completely out of the market and we have all our sight deposits at the ECB, or alternative, we still have our sight deposits with commercial banks, but then we would expect them to back them 100% by central bank money. This has interesting implications. So this could mean that we go for 100% reserve system, which for good reasons can be considered to be much less fragile. It also gives reason for a one-off clearance of the debt, of the bad debt, which are currently still in our system, that would replicate something like the Chicago 2.0 plan from the 1930s. But it would also put the central bank in a position to play around with negative interest rate much more aggressively than they have done so far, because so far there is a brake built into the system, which is to replace money that you hold at the ECB with cash. And the break-even is somewhere around 0.7%. So whenever the central bank wanted to reduce the interest rate below this threshold, then even commercial banks might start to withdraw their deposits at the central bank and rather hold cash. If there is no cash anymore, there is no technical limit anymore for lowering interest rates deeper into negative territory, and which would then result in a situation which is quite similar to what Giselle once proposed, to have something like a demerged currency, where the one who holds the currency will be devalued month by month or quarter by quarter or whatever you design this system. And why would the central bank want to do it? Well, of course, they want to come nearer to the inflation target in the current framework. And I do not want to go too much into the details here, but what the optimal inflation rate actually is controversial in the academic debate. You cannot, or you might not see the axis here. They go from -8% to +8%. And what you find here are the findings of scientific papers arguing for optimal inflation rates to be addressed by the central banks. Most of them are around 0%, but as I said, there are also examples that go to -4% to +6 or 8%. And for those who favor these very high inflation rates, you would probably need very low negative interest rates. Okay, there are also other reasons why the central bank might opt for becoming an issuer of digital money itself. I don't want to go too much into the details here. It is all in the paper. So let me summarize. Technically, now there is more scope to drive interest rates more into negative territory, but there is also a new competitor arising on the scene, and these are the mentioned private issuers of digital money that put the monetary monopoly of the central banks under competitive pressure. And I would argue to give them a fair chance. Let them do it. Do not outlaw them from the beginning. The whole history of money is a history of experimenting around. So stopping these experiments would assume that we know already everything about what the optimal monetary system should look like. And I think it's fair to say that we are not in a situation where we have already all the answers.
Thank you very much. Now we have some time for Q&A. So who wants to start with the question? Please.
Well, maybe I'll jump in. One paper advocated, or at least proposed the idea to consider the synthetic central bank crypto, not the crypto, central bank digital currencies, right? The central banks issue what they issue, they will have account, but the front desk would remain with the financial system, the banks. How it would function, so it's sort of a partnership between the private sector and the central bank sector, let's say. Mr. Kooths, would you agree with that as a transitional, at least, or maybe optimal way of dealing with the situation? Because instability is inherent in the system and something will have to be done. Thank you.
Yeah, of course, technically this would just then be, well, I would say it would nothing be completely new. It would not be revolutionary. I think the interesting thing, what is really new, is that the issuers that we would typically have in mind when we talk about digital money are no longer limited to the national or regional currency areas, but they are creating a global currency area. And actually for good reasons. Money is a network good. It becomes more useful the more people make use of it. So, and therefore, for example, the gold standard, for good reason, was a global monetary standard. And therefore, when we talk about Libra or any other stable coins, they will probably not address a European market or a US market or a Japanese market alone. But what makes them particularly competitive is to go beyond these traditional borders of currency areas.
I just would like to add to this that if we are considering this in terms of regulation, if we have to regulate something about it, we should also do it internationally and then have some coordination across countries.
Let me follow up on this. I mean, why do we have this large amount of regulation in our current fractional reserve system? It is because commercial banks have the privilege to create new money out of thin air via granting credit to the real economy. Therefore, of course, because our monetary system is debt-backed, we have good reasons to look after, well, who do they give the credit to? Therefore, all of these regulations that make sure that they are not overstressing this privilege, that what is backing the system is not just a bunch of bad debt. All this would no longer be needed in the world of digital cryptocurrencies or of a digital currency which has a reserve medium behind it, like gold or anything similar, which no longer has this, no longer allows this possibility for money creating. So therefore, this was really be a paradigm shift with the obvious consequence. It would be the end of monetary policy as we know it. Money would primarily be an exchange medium for practically all people on this planet. And this is not a bug, this is a feature. So we would depoliticize monetary policy. We know how oftenly monetary policy has been misused using the money press to solve non-monetary problems is always a bad idea, but it's always very tempting because you can create purchasing power out of thin air. This is extremely tempting for those who have this privilege. And therefore, I think this is really a fundamental debate that is ahead of us. And I can, of course, understand why traditional central bankers are very reluctant to go along this path.
Thank you. Mr. Rohnt.
Thank you again. I wanted to explore, if you don't mind, this concept of trapped reserves within the system, because when you put negative interest rates on banks' reserves, then obviously there's less, they're losing money on those reserves. I know they're doing tiering now, but essentially the bank is losing money. So not hardly encouraging loan growth. And then there's this other element which I'd like you to mention, which is the target 2 balances and how they fit into the equation. And whether there is this problem within Europe, and it's back to your divergence again, of whether the countries that are, if you like, have experienced the pain in the last financial crisis are merely just transferring their deposits back into Germany, essentially, where they're safest, and whether that's trapping, if you like, money from then being recirculated, and the transmission mechanism isn't working because of target 2. Does that make sense?
Not quite sure whether I get your point. I would say target 2 imbalances are the mirror image of balance of payments financing via the central bank system. And of course, a lot of that is kind of fostered by QE programs, because we are pumping a lot of liquidity into the system, and this liquidity goes, as you said, to the core countries. I think the current approach has already been, to some extent, successful to bring back to life the interbank market, the cross-border interbank market in the euro area, and we already see that target 2 balances have decreased to some extent, because now there is an incentive for core country commercial banks to negotiate with periphery commercial central banks to use this this new kind of buffer that they have. I think it's 6 times the minimum reserve requirements, which is no longer under the negative interest penalty, so to speak. So there's an interest for them to make a deal and then to share the benefits out of this deal. So I would say the most important aspect that we currently see with monetary policy with respect to the target 2 imbalances is this buffer of 6 times the minimum reserve requirements, which is left out of the negative interest rate regime.
So I have one more, if you don't mind, which is in the US, obviously we've seen much faster loan growth. I think it's clipping at around about 5-6% nominal at the moment, whereas in Europe it's 0. Do you think that there is a chance, one of the reasons for that is that there's been a peel back of Dodd-Frank, deregulation in other words. Do you envisage any form of deregulation at all being contemplated by the ECB, either on Basel III or other forms of deregulation that it could encourage more bank lending?
No, I don't see this coming, but also the numbers are not quite correct. Loan growth in the euro area is positive, up to 4%, I think the most recent numbers. Germany is even much more. So we have credit growth in the euro area, for the whole euro area in total as well. But I think you're absolutely right. I mean, none of the large central banks in this world can act completely independently of what other big central banks are doing. And my reading is that the US interest rates would be much higher if the ECB had followed the attempt to renormalize interest rates there. Of course, there is a mechanism via the exchange rate, and this is the most important channel that allows central banks to stimulate the real economy via even more expansionary monetary stances. And this might even feed into a new conflict with the United States, who tend to interpret this as a strategy of competitive devaluation.
I just wanted to add that this actually makes a lot of sense. In the academic literature is actually moving towards the fact that when you are at the zero lower bound, macroprudential policies can be a complement to boost the economy. So actually lowering, increasing loan-to-value ratios or lowering the capital requirement ratio would be a good idea when you are at the zero lower bound. So the academic literature is moving actually towards this idea. So it really makes sense.
Yeah, from a technical point of view, it makes sense. But I mean, why did we introduce these regulations in the first place? Because if you leave this fractional reserve system unregulated, it tends, or less regulated, it tends to create these credit bubbles. And we are in this mess primarily because we had these excessive credit and money creations in the first 10 years of the euro area. And therefore now thinking about relaxing it just in order to get some stimulus power back, I would say is a very bad idea.
But just to find the balance and
Thank
to find
you.
the optimal policy.
This will be debate maybe for Madame Lagarde. But if I may, I was just very shortly, but I must say that I have sympathy for what Ms. Rubio said, because it seems to me that this is not this. We are not talking about cryptocurrencies, but crypto assets, and actually high risk, very high risk speculative assets that are not backed by anything. You know, if you buy the shares or if you buy the bonds, it's backed by something. Here is backed by belief. But I wonder if, in your word, Mr. Kooths, there will be actually more competing digital currencies that will be actively worldwide. What would be meaning of word inflation? Tell me.
Well, it depends, of course, how much money then would be provided by those private issuers and what their incentives are. If their incentives are to provide an as stable means of exchange as possible because they want to see it used widespread all over the global economy, then we would probably see very low inflation rates. But
no, sorry, I asked something different. Because if the exchange rate of those digital currencies is fixed, then they don't have very much added value. So that means there is fluctuating exchange rate. So as the consequence, inflation in each of these currencies will be completely different.
Well, if you think of a construction like Libra, for example, you would probably, well, then you're just replicating the money which is already there. So that wouldn't have, then you would just substitute money which is currently in the system with Libra. But the quantity of money, interest rates, all this would still be managed by the central banks. So I don't see the big impact on inflation and exchange rates.
I'm talking about measuring of inflation, because inflation is measured in the currency, obviously. And because you will have fluctuation of exchange rate, at given months, the inflation in lira will be different than in inflation in euro. This is the same like if you measure the inflation in Eurozone in pound or in euro or in Czech koruna or in US dollar, you will have completely different results. So which of those inflation will be correct?
Well, I see. Well, this should reflect the share of currencies that are actually used by people in the real economy. So if they use 10% of currency A and 90% of currency B, the relevant inflation rate would then be, if they use currency A for 10% of their transactions and currency B for 90%, should then be a weighted average of these two currency-specific inflation rates. This would be my best guess, yeah.
Thank you. We now will have to move to a dialogue with Madame Lagarde, but before that, let me ask my co-chair, actually the main chair of this session, to have concluding remarks.
Thank you, Mr. Niedermayer. I won't have much time. I would spend much time, but we'll continue this dialogue, obviously, for the number of years, I assume, because it's too complicated, too important. I see, as I mentioned, two topics directly related, depending on where we go on money. Then the regulation, monetary strategy would depend on that, at least to a certain extent. And I think, for me at least, the overriding theme could be the third pillar. Potentially, it was mentioned briefly, the financial stability. If we subscribe to that, maybe we could have one set of decisions which could harmonize how to define financial stability. Could be a different and difficult question, but at least I would like to think in this category as well. So thank you very much for your presentations here, for your discussion, Mr. Niedermayer.
I will just conclude. So thanks for presenting your papers. I can promise that I will read the parts that I haven't seen, and thanks for participation and active participation of many of you. And as you said, this is probably not last moment when we are talking on this subject. So next time. And let's now move to the session on real money, let's say prevailing money with the President of ECB. Thank you.